The issue that many traders have is getting out of their trades, especially day trading the profit targets that you're going to use. If you swing trade, you're only going to make that decision a few times every few days or so. As a day trader, you're going to be making profit-taking decisions quite a few times during one trading session. And there are 3 exits for a trade. There's exiting trades for a profit, exiting trades to cut your losses, and exiting your trades at break even, although you're going to still pay your spreads and your commission costs. And you could just keep this all really simple and decide that you're going to risk X amount of pips, for example, per trade. You'll exit your trade at a multiple of the X for a profit. And you'll exit your trade once the amount of pips that you've risked is taken. Now, whether or not that works is another matter. Like anything in trading, test your theories before risking real money. With that method, you're using a risk to reward ratio to decide on your profit targets. But this does not take into account one of the most important parts of a trading chart. Price makes a structure, and the noticeable ones are those that show where order flow has entered the market. And we gotta assume that when price reaches those levels again, something may happen. And depending on what happens, which price action can show you, you'll take action or you're just going to sit on your hands. And for what I want to talk about here, we're going to focus on trending markets to zero in on a concept. A trending market has a rhythm to it, a price flow. We know that markets make higher highs and higher lows when it's moving up and the opposite when it's going down. A higher high can only be made when price pulls back, and depending on your trading method, this presents both long and short opportunities. Looking at this chart here, we can see that price is in an overall uptrend. Price makes a higher high, starts to pull back. At 2, price puts in a higher low, starts to rally. And then price puts in a lower high, starts to drop. And many people will see the rhythm broken and start to think of shorting the market, that's going to be the right play. Price slams through the low, and those that didn't short when that move at number 2 stalled, they pile in on the break. And for you though, you know that trying to catch the trend turns, selling the high in this case, it's difficult. And you also know that the 2-leg corrections, complex corrections, they're pretty common. And you're looking to buy into the uptrend. That's not really broken. And this chart shows the buy at an area where price was supported. So what makes sense at this point? Well, let's look at what probably occurred. All those that went short have their stops in either of the 2 red boxes. What we are not sure of is the strength of those levels. What is the conviction of those sellers? Well, we won't know their conviction until price comes back to those areas where a few events could take place. Price can rally through those levels, price can be rejected short, or price can find balance near the top of the swing. We don't know what's going to happen, but we know this. If price rallies through those levels, that's those that sold near the highs will have to cover by buying, which was going to drive your long positions up pretty quickly. It also confirms that the uptrend is still intact. If price is rejected short, there's a good chance our stops are going to be hit. If price finds balance and consolidates, our patience is going to be tested. And those that lock in some profit may find their stops hit on failed breaks short. So conclusion, we use those areas at profit-taking levels. By taking a profit in those areas, we're using the structure of the market, the rhythm of the market, and we're accepting a few scenarios can play out in those areas to objectively put some money into our trading accounts. Do you leave a runner? Is this the best way to take a profit? Well, this next chart will show you how price reacted to those highs. The shorts, they were ripped out of their positions, and the longs were driven upwards 226 pips from the entry. Full position exits, they banked at 82 pips. So is this a good play? Well, before you say yes or no, let's look at this scenario. You may say you would not have bought the lows, but it's obvious that some people did. They may have seen a big rally up and then take the first pullback in fear of missing that big move. Others may have skipped that first retrace, but after seeing that big green candle, they were waiting for the next pullback to buy. So as you can see, there's nothing guaranteed or perfect in trading. Understanding the context, the structure, and the psychology of the masses can be a huge plus in enabling you to add money to your account on a semi-consistent basis. Using these types of levels for profit taking can be a consistent way to add to your account. Why? Because it takes into account CSP, the context, the structure, and the psychology. Market structure for day trading or swing trading, it's always a good place to start to look for profit targets. Once price reaches those areas, watch the price action to see if you can determine who's winning the battle at those levels. And you want to make sure that whatever you're using for profit targets as a day trader, a swing trader, a futures trader, it doesn't matter, is that the profit targets form a part of your trading strategy and they are in your trading plan. And one method you may want to use as a day trader is to look at higher time frames for the price level that you're going to exit at. Day trading, especially on lower time frames, has a lot of levels that you may look at for possible exit points. Now, I am a minimalist by nature, and I prefer as little decision making as possible. If I can remove levels that appear on short-term trading timeframes by going up a factor of 3 to 5, I'm going to do so. And I don't have any stats to back this up, but I believe that higher time frame levels carry more weight because they're easily seen as opposed to 5-minute levels. And I want to leave this one more method that many traders that I know and that I use, Fibonacci price targets. Use the Fibonacci retracements and extensions to measure the move that you will use to exit your trades. And this is applicable for day trading profit targets as well as longer term trading. And here's where you can find out more about that. So just give it a try.